Question: why does $100,000 feel impossible when it's actually your most powerful asset? If you're putting in $500 a month and watching it crawl, here's the twist. At around 7 years and 9 months with a 7% return, your returns, approximately $54,000, finally outpace your contributions, approximately $46,000. That crossover is the psychological break, the moment compounding gets off the bench and starts carrying you. Stay with me. I'll show you the 3 tipping points: $100,000, $650,000, and $1 million, and one surprising edge at each. Compounding takes over, passive income covers basics, and access multiplies opportunities. First, let's address why the early grind feels rigged. You're consistent, you're investing, yet your balance barely moves. Why does it feel like the system is slow-walking you? In the first decade, there's a mismatch between the work you put in and the progress you can actually see. You show up every month, but the needle barely shifts because your cash does most of the heavy lifting early on. The market's role is small at first, so the feedback loop feels broken. You don't see the dramatic jumps you expected, and that gap between effort and visible results messes with motivation. The math adds to the frustration. Early on, most of the growth is you moving money from checking into your investments. That can feel like pushing a boulder uphill. The market return is there, but it barely shows up next to your deposits, so it seems like nothing is happening. You're not doing anything wrong. This is the structure of compounding in its early phase. Let's ground it with a simple scenario. You contribute $500 a month at a 7% average annual return. In year 1, you put in $6,000 and end with just a bit more than that. By year 3, you've deposited about $18,000, but might see a balance around the low $20,000s. By year 4, total deposits are $24,000, and your balance may hover in the high 20s to low $30,000. The growth is real, but most of the change still comes from you. Year 5 and 6, the curve remains flat to the eye, and progress feels slow no matter how reliable you are. You check statements, you see the numbers inch up, and it feels like crawling. Compounding is on the bench for the first few seasons. Years 1 through 5 are the slog. Your returns exist, but they look small next to your monthly deposits. The ratio is off, and your brain wants a bigger payoff for the effort you're putting in. Think of it like trying to start a fire with wet wood. You stack it, strike the matches, and it smokes more than it flames. It takes patience and consistent heat before it catches. Once it catches, the same effort suddenly produces more warmth. Early compounding is the same. You don't get the big blaze until you've stayed with it long enough. There's a behavioral hurdle here too. When feedback is delayed, people tend to stop or scale back. In a world trained for instant gratification, same-day shipping, on-demand entertainment, notifications every minute, waiting years for obvious progress feels wrong. Your brain learns to chase quick wins, so steady deposits with subtle short-term results feel like a losing game. That's a common response, and it's costly because it interrupts the one ingredient the system needs: time. The early stage doesn't reward you with big jumps, so a lot of savers pause right when they should be holding steady. It's a timing trap. The twist is that this slow phase ends on a schedule. There's a point where the returns stop whispering and start talking. Keep the same $500 a month at 7%, and the moment arrives around 7 years and 9 months. At that point, your returns, about $54,000, finally outweigh what you've put in, about $46,000. That's the wall breaking. The boulder you are pushing starts rolling, and it doesn't need the same push from you to keep moving. The feeling shifts from "I'm carrying this" to "this is carrying me," and you can sense it in the monthly changes. What changes at that point isn't just the number on the screen. your dollars begin to earn more dollars in a way you can finally feel month to month. The experience shifts from labor to momentum. You still contribute, but it no longer feels like you're the only engine. The effort to progress ratio flips, and the market share of your growth grows faster than your deposits do. That's why crossing $100,000 is more than a round milestone. It's the point where progress stops feeling linear and starts compounding in front of you. And once that engine is running, the next move isn't about working harder. It's about understanding what actually changes when your portfolio touches six figures. What actually changes the day your portfolio touches six figures? The number isn't just a round milestone, it's a structural shift in how your money grows. Up to now, it felt like effort outweighed progress. At $100,000, the math tilts. You're no longer asking deposits to do all the work. Now, your base is large enough that returns start to matter more than your schedule. Think of $100,000 not as 1/10 of a million, but as the pivot where the engine changes gears. When the base is small, returns can be accurate and still look underwhelming next to your deposits. With six figures, the scale increases every result. A steady 7% on $20,000 doesn't move the needle. The same rate on $100,000 is different math altogether. This is the point where the system finally behaves the way it was supposed to from the start. Here's why the belief in straight-line progress backfires. If you expect identical gains month after month, the normal ups and downs will feel like setbacks. Real growth compounds in uneven steps. Early on, your balance rose mostly because you contributed. Now, growth stacks on top of growth, so the jumps come from the base expanding, not from you pushing harder. Expecting linear results after $100,000 leads to frustration because you'll either overreact to volatility or underestimate how quickly the curve can bend. Run the numbers. A 7% return on $100,000 is about $7,000 a year. That's more than a full month of $500 contributions. Without raising your savings rate, your portfolio can now add an extra 13th payment on its own. And that $7,000 doesn't sit still. Next year, it also earns. The engine that idled through the early years now revs because the base finally has weight. From here, each dollar in the old account starts recruiting more dollars. Your savings rate still matters, but compounding becomes the main driver. You'll notice it in how quickly the totals climb after flat periods. Instead of feeling like you're hauling the growth, you're steering it. The habit that carried you to six figures now gets an upgrade from the math. Look at a few checkpoints to see how the dynamic changes. With steady $500 monthly contributions and a 7% average return, the climb from $100,000 to $200,000 takes roughly 5 additional years, much shorter than the nearly 8 years it took to hit the first $100,000. Push further, and the acceleration stands out. Around year 18, the balance sits near $400,000. Stretch to about year 22, and it lands close to $600,000. The striking part isn't just the bigger numbers, it's the shift in who did the work along the way. By about year 18, roughly 3/4 of your balance comes from market growth rather than what you deposited. That's a concrete psychological milestone. The market is now the primary engine. Early on, you carried most of the weight. By this point, the market does most of the lifting. That realization changes how you show up. You feel less pressure to force progress and more commitment to protect the process. Keep contributing, stay invested, and let time do what it's built to do. Hitting $100,000 also compresses the time between milestones. Momentum stacks faster because every uptick compounds on a larger foundation. The distance from $100,000 to $200,000 is shorter than the grind from $0 to $100,000, even if your monthly contribution never changes. Then the intervals keep shrinking as the base grows. What used to be a multi-year climb starts taking fewer and fewer calendar pages because the base keeps multiplying the effect. So when you cross six figures, the script flips. Your money pulls more weight than you do. Contributions still matter, but your balance compounds with a force you can feel in real time. That shift doesn't just add dollars. It starts to open room in your life for different decisions. Because when your portfolio can shoulder more of the load, the definition of what risks are worth taking begins to change. What number turns passive income into real leverage over your life choices? Around $650,000 starts to act like that switch. At roughly an 8% return, you're looking at about $52,000 a year flowing in without a time clock. That's not yacht money, it's breathing room money in a lot of cities, enough to cover a modest lifestyle and strip out the constant pressure to earn every dollar with your time. Let's keep it simple. At that level, your portfolio can generate close to $1,000 a week before taxes and depending on where you live and how you structure withdrawals. Rent or a mortgage? Covered. Groceries, utilities, transportation? Covered. Health insurance and phone bill? Likely covered. You might still choose to work, but you don't have to accept every demand just to keep the lights on. That difference shifts how you negotiate with your employer, pushing for flexibility, equity, or remote terms, and how you plan your year. You can pass on low-value projects, take a role with better upside, or step back to upskill without the same income anxiety. The common belief is you need several million to have freedom. That bar keeps people stuck because it feels out of reach. Challenging that assumption matters. If a base of $650,000 throws off a middle-class income, you're at the point where money buys time and options, not just shiny upgrades. It can supplement your job, replace part of your salary, or backstop a transition. The fear of missing a paycheck loses its edge when the essentials are funded by your capital. Here's the deeper shift. You move from survival decisions to opportunity decisions. When the non-negotiables are covered, you can evaluate moves by expected value, not immediate cash flow. Starting a business becomes a calculated project with a defined runway. Learning a new skill isn't a luxury, it's a plan with a payoff window. Taking a lower base with higher upside becomes a reasonable bet because the downside is inconvenience, not crisis. That reduces panic, stretches your decision horizon, and makes sticking with a strategy more likely. Consider a straightforward runway. You hold $650,000 in a diversified portfolio and target an 8% yield across dividends, interest, and total return. That's roughly $4,300 a month before taxes. You allocate $3,000 to core living costs and reserve $1,300 for a modest business budget, software, initial marketing, and a few contractor hours. You set quarterly milestones, prototype by month 3, first paying customers by month 6, break even by month 9. If you miss a milestone, you pivot without draining principal. If the venture works, great, you've created a second engine. If it stalls, your baseline holds. You can regroup, consult part-time for targeted income, or take a role with equity while your portfolio still pays the bills. The risk profile changes because the downside no longer threatens basics. You're risking time and measured capital, not housing or food. That's risk you can price and cap. You can model a 6-month test, set a maximum spend, and keep your investment base intact. With the portfolio covering essentials, you define acceptable failure and negotiate from strength. Taking contract work, pushing for project-based pay, or choosing roles with long-term equity. There's another lever here. You don't need to spend the full $52,000. The unused income compounds on top of the base. Draw half and reinvest half, and you accelerate the march to the next milestone. Your money throws off income. The income buys more assets, and the new assets add to next year's income. It's a tighter feedback loop than you had before, and consistency makes it stronger. This is how you shorten the time between milestones without increasing your workload. So $650,000 isn't just a balance, it's a permission slip. It turns decisions that used to feel risky into controlled experiments with guardrails. It gives you room to say no, to wait for a better fit, or to back your own ideas without betting the house. Keep stacking that discipline, and the next tier isn't just a bigger number. It's a different level of leverage and access that changes how you operate. What opens up after $1 million that wasn't even on the table before? Crossing 7 figures doesn't just feel different. It changes what you can do. You move from playing defense with savings to getting real leverage from your capital. Doors that were previously shut start to open, and the conversation shifts from, "Can I afford to try this?" to, "Which opportunity fits my plan?" Let's lay out the path that gets you here. You've been steady, around $500 a month, compounding at roughly 7%. You land near the million mark in about 29 years. It's not flashy, it's methodical. The reason it works is time. You let compounding stack gains on gains, and the consistent deposits keep the flywheel turning. The first decade feels slow. The third decade pulls you forward, even if your contribution never changes. Here's why you don't coast once you see 7 figures. People relax at exactly the point where vigilance matters most. With more capital, your mistakes scale too. Sloppy allocation, over-concentration, or chasing hot tips can undo years of work. Your edge comes from keeping a simple, rules-based process, clear targets, rebalancing on a schedule, and a written plan for when markets run or stumble. You didn't need much discipline to start, you need more to protect what you've built. Access changes the game. With $1 million, you can write checks that qualify you for deals you couldn't touch before. Angel investments in early-stage startups, limited partner slots in real estate partnerships, and small business acquisitions that require meaningful equity. Banks treat you differently as well. Better terms show up when you bring strong collateral and a track record. This isn't about chasing complexity, it's about selecting a few higher quality opportunities from a bigger menu and letting your capital buy influence, not just assets. Income strategy is where it becomes practical. Standard guidance often anchors to lower, safe withdrawal rates, but when your target return is higher than your draw, you can maintain purchasing power. A 6 to 7% withdrawal target, while aiming for 8 to 9% returns, can keep your principal growing while covering living costs. That gap between what you withdraw and what you earn is your inflation buffer. It keeps purchasing power from eroding and lets your baseline rise over time. If markets are generous, you bank the excess. If they're tight, you lean toward the lower end of the range and preserve the engine. Resilience improves because the portfolio can pay you while you wait. When a diversified mix spins off income, drawdowns feel less threatening. Dividends, interest, and rental distributions keep the lights on while asset prices reset. You aren't forced to sell the good stuff at bad prices. You can follow your plan and rebalance into weakness instead of reacting to headlines. And over decades of consistent investing, downturns can help because your contributions buy more shares when prices are lower and the recovery multiplies those extra units. Another layer helps extend the runway. The average Social Security benefit sits near $1,900 a month. That's over $22,000 a year supplementing your draw, which can lower your withdrawal rate and reduce sequence risk. The combination of steady portfolio income and that baseline support gives you room to adjust without compromising your long-term plan. Now shift the mindset. Treat the first million as the beginning of compounding dominance. The math tilts in your favor when the base is large. Each percentage point moves real dollars. The second million arrives faster than the first because you're building on a bigger foundation. The jump from $2 million to $3 million only requires a 50% increase, and each step up takes less calendar time when you keep the process tight. 7 figures becomes validation and a tool. It signals that your process works, and it arms you with access, income flexibility, and resilience. Probability tilts your way when you stay systematic, keep costs low, and make decisions on a schedule, not a mood. The next step is turning those advantages into a short, repeatable, disciplined cycle that keeps the flywheel spinning. If the math is clear, why do most people never reach the first milestone? Because willpower leaks and many quit right before the momentum shows up. Shrink the horizon. Run a 90-day plan, automate $500 a month, or your best number, schedule deposits the day after payday, and use diversified, low-cost index or target date funds. After 90 days, raise contributions 10%. Habit research shows 60 to 90 days cements behavior, and small bumps compound over decades. Freeze lifestyle inflation by routing a fixed slice of every raise or bonus straight to investing. Track monthly contributions versus growth. Early on, contributions dominate. That's normal and temporary. Send 50% of windfalls to investments. Build the system, then don't break it. The first $100,000 is the hardest, and staying consistent through the boring years turns frustration into acceleration.